It's really hard to believe that we are almost at the midway point of 2026, and what a year it has been. But I was struck recently by the passing of Alan Greenspan, the former Fed chair who guided that committee for 18 years through some of the most difficult economic and financial conditions that we have seen in this country. And for that, some thought he was great and some had some less favorable opinions of him. And I saw a quote today that I thought really described him perfectly. He was one of the greatest yet most contentious figures in modern economic history. That pretty well sums it up. But another thing about Alan Greenspan that's very timely is that he was a much less transparent chair of the Federal Reserve than what we've been dealing with over the last decade. He really did not like to provide much information to the media, to the public. He let the committee go into closed doors, and whatever they came out with, that's what we dealt with. It strikes me so ironic that we are about to enter into what feels like a very similar period for the Federal Reserve, as our new chair, Kevin Warsh, has already made it well known that he wants less transparency with the Fed. Kind of deja vu all over again. Greenspan didn't give press conferences. Dot plots didn't exist back then. And he was a master at giving speeches that provided little to no forward guidance. And it feels like we're right back in this again. We just had the first FOMC meeting under the guidance of Kevin Warsh, and it was an interesting one. The result was expected. No change in policy rates, no change to the balance sheet, but a few things that will be changing in the future, as he announced a series of task forces that he has put together to study some things the Fed should be thinking about, like inflation, like how to handle the balance sheet, but also how to handle Fed communications. So we'll learn a lot more about that over the next few months. He did say he'd like to have it all wrapped up by the end of this year, and we'll see where that takes us. In the meantime, it was also very clear he is trying to manage a very divided committee. We saw the dot plots for the June meeting, and there were 9 committee members that would like to raise rates, 8 that want to keep them steady, and only one that wants to lower rates. But if you do the math, that's only 18, and there's 19 voting members, because Kevin Warsh broke from tradition and did not submit dot plots. Just the start of less transparency, perhaps. If you look at the statement from the last meeting, it doesn't compare at all to the one from the previous meeting. Typically, you get side by side and yellow highlights that might show you where the changes were made, and sometimes there's only a couple of lines. This one, both statements were almost completely in yellow because everything changed and much less was shown. It's going to take some time to see if less transparency leads to greater market volatility or if somehow it dampens it. We certainly shall see. But in the meantime, our view on the U.S. economy hasn't really changed much. We remain pretty constructive. If you look at real-time indicators of U.S. GDP growth, the economy is running at about 3% right now. Labor markets are certainly helping the consumer to feel confident, and that is a big reason why we are seeing decent growth. Also because of a huge CapEx spending boom that is going on, which is feeding into labor market growth, but it's also feeding into economic growth, and that's important as well. The labor markets have shown 3 consecutive months of significant payroll expansion well beyond what was expected. And more importantly, in those same 3 consecutive months, upward revision to prior data, which is something we haven't seen for a long time. We do continue to believe that the strong labor markets, the tax refunds that the consumer has enjoyed, and more importantly, the fact that the inflation we have dealt with so far, mostly from geopolitical challenges, hasn't bled through into core goods and services. And that's what's really important for the consumer. They can manage through some spikes in food and energy if at the end of the day, it's not on everything they are trying to consume. And that's really what we're seeing in the economy right now. But inflation still remains the challenge. And even if this negotiation with Iran proves successful and we come out the other side with a solid peace agreement, we still think inflation provides enough of a challenge for the Federal Reserve, given the fact that we are going through a technology transformation. And there are other factors that continue to push inflation and prices higher. With that, we think the Fed most likely have to just stay right where they are for a good amount of time from here, probably through the end of this year anyway. So constructive on the economy, and what we continue to see is, we've got a period of time now where the U.S. midterm elections are only a few months away. We do have geopolitical challenges around the globe, even if it's not Iran within a few weeks. And when you combine that with everything else that's going on, uncertainty is a little bit heightened. But so far, the lightning rods for that remain U.S. Treasury yields and equity markets. In the meantime, fixed income spreads across nearly all sectors continue to trade in a very narrow range. And so where that has left us is continuing to like to be around a market weight in the credit areas of the market and really look to add value through the structured sectors. There's spreads there for quality and duration can really provide some nice all-in yields that make a lot of sense for client portfolios. So it's hard to believe we only have about 6 months left of this year. It's been a wild ride so far. We'd love to see it be a little bit less so as we work our way through the balance, but tough to have that confidence with all that lurks out there. In the meantime, we'll keep watching it closely and certainly come back and tell you our thoughts if things dramatically change.